If you invested $100,000 into an index fund today, which one would actually grow your money more? Fidelity or Schwab? That's the $1.5 million question we're looking into. In this video, we're putting $100,000 into Fidelity's index funds versus Schwab's head-to-head. We're talking real numbers, fees, performance, dividends, and how all of that compounds over decades. Both providers offer funds across the same categories, making this a genuinely fair matchup. We'll go head-to-head across 5 rounds. Fees, the S&P 500, total market, bond market, and international. And at the end, you'll see how one of these providers leaves John with a bigger portfolio, $1.5 million more to be exact. But before we get into the rounds, let's quickly cover the basics, because if you're newer to investing, this will make everything that follows a lot clearer. An index fund is basically a basket of investments. So instead of picking individual companies and betting your money on your own instincts, you spread it across hundreds or even thousands of stocks all at once. Most index funds follow a specific market benchmark, like the S&P 500, and aim to match its performance as closely as possible. Because they don't require a team of managers constantly trading in and out of positions, the costs stay extremely low. You invest once, leave it alone, and let time do the heavy lifting. So the real question is, who's offering the better one? Is it Fidelity or is it Schwab? Fidelity, founded back in 1946, manages over $18 trillion in assets. In 2018, they made history by launching the world's first zero-expense ratio index funds. Zero, as in nothing. We'll unpack what that means in just a minute. On the other hand, Charles Schwab, founded in 1971, manages just under $12 trillion in assets. They built their reputation pioneering the discount brokerage model. Their index fund and ETF lineup consistently ranks among the cheapest in the industry. On the surface, both look like safe bets. Both are legitimate, battle-tested institutions. Both deserve your consideration. But John's not here to pick a brand. He's here to pick the one that grows his $100,000 the most. And when you're investing that kind of money, small structural differences don't stay small. They compound over decades. So let's start with the number that matters most for any passive investor. Here's the good news for John. Both Fidelity and Schwab are among the lowest cost investing platforms out there. Both offer commission-free trading on U.S. stocks, ETFs, and most mutual funds. Neither charges account minimums for standard brokerage or IRA accounts. But dig a little deeper, and the differences start to show. On expense ratios, that's the annual fee a fund takes from your investment automatically every year. The base cost from either Schwab or Fidelity is the same, 0.02%. But Fidelity offers a lineup of index funds with a 0% expense ratio, including FZROX, FZILX, FNILX, and FZIPX. Schwab has no direct equivalent. For a pure buy-and-hold investor, that is a structural cost advantage that cannot be ignored. On options trading, both firms charge 65 cents per contract. Neither charges annual account maintenance fees on standard accounts. They're perfectly tied there. So John looks at the full picture and gives this round to Fidelity. Their zero expense ratio funds are genuinely unique in the market. For cost-conscious, long-term investors, Fidelity simply costs less. But fees are only one piece of the puzzle. The real test is what the money actually does once it's invested. And the most popular place to start that test is the S&P 500. You've probably heard this name more than any other in investing. It is the gold standard of U.S. stock market investing. The S&P 500 tracks 500 of the largest publicly traded American companies. And when people say the market went up, they're almost always talking about the S&P 500 moving higher. Over the last 10 years, it's delivered more than 14% average annual returns. That's one of the strongest long-term track records in investing history. Both Fidelity and Schwab have built their flagship funds around this benchmark. Fidelity's version is FXAIX, the Fidelity 500 Index Fund. Schwab's is SWPPX, the Schwab S&P 500 Index Fund. Same 500 companies, nearly identical proportions. On the surface, they look almost identical, but John wants to see for himself what $100,000 actually does in each one. He starts with Fidelity's FXAIX, their flagship S&P 500 fund. John puts in his $100,000, sets every dividend to reinvest, and lets the calculator run. After just 1 year, his portfolio would grow to $114,090. Fast forward to 10 years, and it would be sitting at $362,214. Stretch that out to 20 years, and John's looking at $1,259,752. And after 30 years, his original $100,000 is projected to reach $4,310,902. Out of that, $4,153,035 would come from capital appreciation and $57,867 from reinvested dividends. That's $4,210,902 in total value added to his initial investment. Now John runs the exact same scenario with Schwab's SWPPX. Same $100,000 going in, same dividend reinvestment, same timeline. After 1 year, his portfolio would grow to $114,010. After 10 years, $363,470. After 20 years, $1,279,591, and after 30 years, Schwab's version is projected to reach $4,427,056. Out of that, $4,232,232 comes from capital appreciation and $94,824 from reinvested dividends, a total of $4,327,056 in value added. So Schwab comes out ahead by $116,154. Both funds hold the exact same 500 companies in nearly identical proportions. So what's actually creating that gap? Well, it comes down to one thing: dividend growth. SWPPX has been growing its dividend at 7.07% annually compared to FXAIX's 4.16%. That might not sound like much year to year, but over 3 full decades, that difference compounds into real money sitting in John's account. So he gives this round to Schwab, and it's 1 point each. But that $1.5 million gap I mentioned at the start, it doesn't come from the S&P 500. It comes from the next 3 rounds, and the first one is where the numbers start to separate. What happens when John goes beyond the 500 largest companies and puts his $100,000 into the entire U.S. market? So the S&P 500 covers the 500 largest U.S. companies. The total market fund goes much further, adding mid-size and small companies. The S&P 500 completely excludes. These smaller firms often carry higher growth potential, and including them gives a portfolio genuine depth. Think of it this way: if the S&P 500 is the skyline, the total market fund is the entire city. Fidelity's entry is FZROX, Fidelity's Zero Total Market Index Fund. Schwab counters with SWTSX, the Schwab Total Stock Market Index Fund. Both cover roughly 2,500 to 2,900 publicly traded U.S. companies and follow similar market cap-weighted strategies. The holdings overlap significantly, but John's already learned from the S&P 500 round that similarity doesn't mean identical. John starts with Fidelity's FZROX, their total market fund. He puts in his $100,000, sets every dividend to reinvest, and lets it run. After just 1 year, his portfolio is projected to grow to $114,470. Fast forward to 10 years, and it would be valued at $377,990. Stretch that out to 20 years, and John's looking at $1,382,428. And after 30 years, his initial $100,000 is projected to reach $4,968,992, paying around $7,022 in annual dividend income. Out of that, $4,772,602 would come from capital appreciation and $96,390 from reinvested dividends. Total value added to his original investment, $4,868,992. Now he runs Schwab's SWTSX through the same scenario. Same $100,000, same reinvestment, same timeline. After 1 year, his portfolio would grow to $113,670. Fast forward to 10 years, $350,529. Stretch that to 20 years, $1,182,861. And after 30 years, Schwab's total market fund is projected to reach $3,922,518, paying around $3,967 in annual dividend income. Out of that, $3,753,921 would come from capital appreciation and $68,597 from reinvested dividends. Total value added, $3,822,518. Fidelity finishes ahead by $1,046,474. This time, the main driver isn't dividend growth, it's share price appreciation. SWTSX posts 12.57% annually versus FZROX's 13.43%. That 0.06% gap doesn't sound like much, but give it 3 decades, and it compounds into a meaningful difference. This round goes to Fidelity. So that's 2 rounds for Fidelity, 1 round for Schwab. John's watching Schwab fall behind and wondering if it can fight back. And the next category is one most investors skip over entirely. That's usually a mistake. Bond index funds rarely get the spotlight, but for any investor serious about portfolio balance, they're not optional. They're what keep your portfolio steady when equity markets turn ugly. Now, bonds work differently than stocks, and it's worth understanding why. Share price appreciation in bond funds is often lower over time because bond prices move inversely to interest rates. That sounds alarming at first, but it's not the whole story. The real return engine in bond funds is the dividend income, paid out consistently, reinvested over time, and compounded across decades. That's where the numbers get interesting. Fidelity's fund here is FXNAX, the Fidelity U.S. Bond Index Fund. It tracks the Bloomberg U.S. Aggregate Bond Index, covering investment-grade bonds across government, corporate, and mortgage-backed securities. Schwab counters with SWAGX, the Schwab U.S. Aggregate Bond Index Fund, tracking the exact same Bloomberg benchmark, same index. But as John keeps learning, same index doesn't always mean same result. John starts with Fidelity's FXNAX, $100,000 in. After just 1 year, his portfolio is projected to grow to $112,630. Fast forward to 10 years, and it would be valued at $328,504. Stretch that to 20 years, and John's looking at $1,079,150. And after 30 years, his initial $100,000 is projected to reach $3,545,051, paying around $113,311 in annual dividend income, or $9,443 per month. Out of that, $2,463,089 would come from capital appreciation and $981,962 from reinvested dividends. Total value added to his original investment, $3,445,051. Now let's run Schwab's SWAGX through the same 30-year scenario with John's $100,000 invested. After just 1 year, his portfolio would grow to $112,470. Fast forward 10 years and it would be valued at $323,867. Stretch it out to 20 years and John's portfolio would be worth $1,048,900. And by year 30, his initial $100,000 is projected to reach $3,397,042, paying around $121,722 in annual dividend income, or $10,144 per month. Out of that total portfolio value, $1,065,523 would come from reinvested dividends, with share price appreciation sitting at $2,231,518. Total value added to the initial $100,000 investment would be $3,297,042. Here's what's interesting about this one. Schwab actually starts with a higher dividend yield, 4.03% versus Fidelity's 3.6%. On paper, that looks like an advantage. But Fidelity's dividend growth rate is stronger, 9.03% annually versus Schwab's 8.44%. And over 3 decades, that faster growth rate overtakes the higher starting yield and compounds the gap wider with each passing year. By year 30, Fidelity is paying $113,311 a year in dividends, while Schwab is paying $121,722. But Fidelity's overall portfolio value of $3,545,051 clears Schwab's $3,397,042 by $148,009. A narrower margin than the other categories, but again, a clear win for Fidelity. The score now stands at Fidelity 3, Schwab 1. The next category is the one that takes John's money outside the United States for the first time. Up to this point, every dollar of John's $100,000 has stayed inside the U.S. market. But with American stock valuations sitting at historically elevated levels, international diversification has become one of the most important conversations in investing right now. Developed market international funds give you exposure to large established economies outside of America, countries like Japan, Germany, the United Kingdom, France, and Australia. These markets tend to offer lower valuations and higher dividend yields than U.S. equities, and they can smooth out your returns when the American market hits turbulence. For a long-term investor, international exposure isn't just nice to have, it's a smart strategy. Fidelity offers FSPSX, the Fidelity International Index Fund. It tracks the MSCI EAFE Index, covering large and mid-cap stocks across 21 developed market countries outside of North America. Schwab counters with SWISX, the Schwab International Index Fund, which follows the exact same MSCI EAFE benchmark. Same index, same territory. But as John has seen 4 times now, same benchmark doesn't guarantee the same outcome. So let's say John puts $100,000 into Fidelity's FSPSX today. After just 1 year, his portfolio would grow to $109,900. Fast forward 10 years, and it would be valued at $257,026. Stretch it to 20 years, and John's portfolio would be worth $660,623. And by year 30, his initial $100,000 is projected to reach $1,697,973, paying around $47,123 in annual dividend income, roughly $3,927 a month. Out of that, $1,105,668 would come from capital appreciation and $492,305 from reinvested dividends. Total value added to his original investment, $1,597,973. Now, John runs Schwab's SWISX through the same scenario. Same $100,000, same reinvestment, same timeline. And after 1 year, it comes to $108,600. After 10 years, $228,730. After 20, $525,961. And after 30 years, Schwab's International Fund is projected to reach $1,216,036, paying around $29,397 in annual dividend income, or about $2,450 per month. Out of that, $786,094 would come from capital appreciation and $329,942 from reinvested dividends. Total value added, $1,116,036. Fidelity finishes ahead by $481,937, and this time, both factors are working in Fidelity's favor. A higher starting dividend yield, 3.05% versus Schwab's 2.46%, combined with stronger dividend growth at 6.85% versus 6.37%. When you're reinvesting every payout for 3 decades, those differences stack up fast. This round also goes to Fidelity. So after 5 head-to-head rounds, here's where we stand. Fidelity wins on fees, total market, bonds, and international. Schwab takes the S&P 500. Final scoreboard, Fidelity 4, Schwab 1. But the scoreboard really only tells part of the story. The dollar figures tell the rest. In the S&P 500, Schwab's SWPPX beat Fidelity's FXAIX by $116,154 over 30 years. That's Schwab's only win, and it's a real one. The dividend growth rate on SWPPX compounds into a meaningful gap over 3 decades. But Fidelity pushed back hard across every other category. In the total market round, FZROX finished $1,046,474 ahead of SWTSX, driven by stronger share price appreciation at 13.43% versus 12.57%. In bonds, FXNAX cleared SWAGX by $148,009. Not a blowout, but a clean and consistent edge built on superior dividend growth. And in international markets, FSPSX added $481,937 more than SWISX over the same 30-year window. Fidelity's combined average across its 4 winning categories totals $1,676,420. Subtract Schwab's $116,154 edge in the S&P 500, and Fidelity comes out ahead by over $1.5 million overall. That's why the final winner in this matchup is Fidelity. The fee advantage is structural. The total market gap is over $1 million on its own. The bond and international margins confirm the pattern. When everything is added together, Fidelity's funds leave John with a larger portfolio after 30 years by over $1.5 million. Now, if you want to see what happens when you start with just $1 a day in Fidelity Index funds and how far that goes over the long run, click the video on the screen.